Hello and welcome. Brian Davis here, founder of Spark Rental. Super excited to be with you as always. And I am here today with Marc Bautis. He's a financial planner and founder of Bautis Financial. He works with real estate investors and others to build wealth, retire younger, and make all the money. And more importantly, save and invest all the money. So Marc, welcome to the show.
Thanks, Brian. It's great to be here.
Yeah. So not only are you a financial planner, but you are also a real estate investor yourself. So just give us a little bit of background here on your own real estate investing history.
Yeah, so I think it actually started kind of coinciding with my work as a financial planner. Some of the first people I started working with were real estate investors. They didn't want to invest in Apple stock. They didn't want to invest in the hottest Fidelity fund. They wanted to invest in real estate. So I said, okay, I better figure out how to help them invest in real estate. And in doing so, I said, okay, maybe, I'm going to eat my own dog food. If I'm going to help them invest in real estate, I better, or I should do it myself. And I looked at, like everything, the pros and cons, how does it fit into my investment portfolio? And that's really what got me started. And the first, I guess, kind of way that a lot of people get started into it, I bought a 2-family, lived in the bottom floor, rented out the top floor.
House hacking.
Yep. House hacking. My family started to grow. We moved out and kept the 2-family as a rental property, and it kind of, that kind of blossomed it.
Well, I love that. And beyond that original duplex or 2-flat or whatever you want to call it, did you go out and buy additional rental properties, or did you switch to passive real estate investing at that point?
So I'd say both, and kind of both at the same time. So I went out, actively bought a couple of 1 7-unit, 1 6-unit building. And they were outside of the where I was living. So, you had to go through everything of getting a property manager in place and managing these properties remotely. But also at that same time, there were different syndications that came out in some local to where I was, some in, some of the areas that were booming across the US. And I've gotten involved in those as well.
So for any audience members who aren't familiar with the term syndication or real estate syndication, it's a fancy word for a group real estate investment where a bunch of people all go in on a project together. You just write a check or send a wire or ACH in the modern world, but you are not involved in the actual management of the day-to-day. You just invest financially and you become a small fractional owner in a big apartment complex or mobile home park or whatever it is. So Marc, tell us just out of curiosity a little bit about some of the real estate syndication deals that you have invested in personally.
So I'm from New Jersey. One of the, I guess over the last, and we'll take it back, it's like over the past 20 years, one of the hot areas is called the Gold Coast, which is across from New York, the river from New York City on the New Jersey side. And you got towns like Jersey City, Hoboken, where these areas have boomed over the past 20 years. And, with that boom comes developers looking to do projects, and then developers looking for financing or help with partnerships into those projects. And, they would come up with different deals, and, we'd look and we'd evaluate each deal. And, we went on a few of them that looked like they made sense.
That's awesome. And it does help. You don't have to, of course, but it does help to invest in local markets that you understand well yourself. So, in our investment club, we aim to invest all over the country. But, if you're just getting started with syndications, if you do want to invest by yourself in a syndication deal, then it can be fun and advantageous to invest in a housing market that you know personally. So, Marc, I want to talk for a minute here about using real estate as a vehicle to invest for retirement, because that's something that you and I were talking about before the show, is something that you work with a lot of clients on. And it's something that in our club, we see a lot of members invest, either with a self-directed IRA or some other vehicle. So tell us a little bit about how you advise your clients when they come to you and express interest in investing in real estate specifically for retirement.
Yeah, so I think there's really 2 ways that you can use real estate to invest in retirement, right? One is just the straightforward way. It's not using retirement funds. You're just using regular money, regular cash to invest in a project. And that's whether it's in a syndication or whether you're purchasing the property or project, or you're doing it on your own. Now, what a lot of people came up to me and they said, well, I wouldn't mind buying this property by myself, but I don't have the capital to necessarily do that. And obviously every project is different and the capital needs are different. And then we would look at, okay, let's kind of take and I'll always say, whether someone, whatever someone's doing with planning, you want to treat yourself as a business. First two things you want to do is put together your own personal balance sheet, know your assets, know your liabilities, and then also your cash flow statement, know what's coming in and what's going out. So we did that, and we would look at their assets, and they would have this lump of money saved in, some people in an IRA, or some people in an old company 401k. And we said, okay, this can be a source of capital that you can use. Now, you don't really see this on TV. You won't see Schwab or Fidelity or Vanguard promoting using your IRA to buy real estate, but you are allowed to do that. Really, the only two things that you can't put into an IRA is life insurance or collectibles. So you can invest in real estate and many other investments that are kind of your not typical investments. And the rules are a little bit different because it is under this IRA or retirement account qualified. It's called a qualified retirement account umbrella, but the capital is available for you to use. And that's whether you're going in on the syndication or your IRA can actually take title of a property. So you can go and purchase a property just like you would, but instead of having your personal name or an LLC that you created, it's your actual IRA that's actually taking title of the property.
So I want to dig a little bit deeper into that. So there's so much to discuss here. So yeah, some of our members, they use a self-directed IRA. So they go out and they pay a custodian an annual fee in order to invest in real estate with their self-directed IRA. It's a lot easier, at least for our club members, who can invest relatively small amounts. So $5,000 in a syndication deal instead of the typical $50,000, $100,000 that private equity real estate syndications require. If you're trying to invest $100,000, say in a syndication, and you can only contribute, $6,000 or $7,000 a year to your IRA, it's hard to reach that minimum investment, right? But if you can invest $5,000, then that makes it a lot easier. Now, some people want to invest directly in properties, go out and buy rental properties directly with their self-directed IRA, and they go out and they get a mortgage, to cover most of the purchase price, since houses are expensive, right? Rental properties are expensive, and again, you're not going to be able to come up with $300,000 probably from your self-directed IRA. But then you run into things like UBIT and some challenges. You have to separate out what portion of the property's profits, get the tax advantages of the self-directed IRA, which don't. So break that down a little bit for us in simple terms, because this gets really confusing for people really quickly.
Sure. So like you mentioned, you can get a mortgage on a property that you're buying with your self-directed IRA. However, it's not a typical mortgage that you would get if you weren't, if you were just using regular funds to purchase it. The main difference is that a mortgage with your IRA, it has to be what's called a non-recourse loan. So let's say you're just buying a property using regular money, you get a loan for it. Most likely, if you look at the details, you're personally guaranteeing that loan. So if something goes upside down, the lending company can come after your personal assets to try and recoup that mortgage. It's different with your IRA. Your IRA is its own entity, not associated. Obviously it's associated with you, but it's not connected to you. So a non-recourse loan means they can come after your IRA, but that's it. They cannot come after any other asset that you own. So now it gets, the lender looks at this as, this is probably a little bit more risky of a loan for them on their side because they have less that they're able to come after. So what that typically means is that the interest rate is going to be a little bit higher. And also they're going to look at the financials of the property in a little bit more detail because they want to make sure that the cash flow makes sense. Because there are ways to get money into your IRA if the need arises. And just to take a step back, when you do invest with your IRA, anything that comes in or out of that property has to flow through the IRA. So like rents coming in go into the IRA. Expenses, like if you need to repair the roof or replace the roof, that has to come out of the IRA. So you have to make sure that, and if the IRA the property can support itself, and that if it doesn't, or if you do need to add cash, that you have the ability to do that. So that means you can make a contribution, or maybe you have another IRA somewhere else that you can transfer funds into. But going back to the loan side, you're not going to be able to walk into your Bank of America or Wells Fargo or typical lender and say, I want to invest in a property using my IRA and getting a loan from you. They're most likely going to say, we don't offer those types of loans. So just like there are specific custodians or financial institutions that will allow you to have an IRA that will invest in properties, there are specific lending companies across the country that will offer these types of loans. So they're a little bit different, but the concept is the same. Your IRA can use leverage, can use a loan to purchase property. The other thing you mentioned is the UBIT or...
Well, let me pause you actually before we get to UBIT, because there's so much you just covered, and people get hung up on some of these details. So first of all, let's say that you have a property that needs a major repair and you own this property under your IRA and needs a more expensive repair than your self-directed IRA cash account can cover.
Mm-hmm.
And let's say that you already maxed out your contributions for that year to the IRA. How do you handle that? Like, how do you go about making that cash infusion into the IRA to cover this big repair expense if you can no longer legally contribute any more money to the IRA?
So the most typical way that I'll see someone do this is that when they do purchase a property, they don't use their entire IRA. So let's just, as an example, let's say they spend $25,000 on this purchase from their IRA. Hopefully, if this arises, that there is other funds in their IRA that they haven't used yet, and they're able to transfer into their self-directed IRA. So let's say they have the typical Schwab or Fidelity IRA. They're invested in some ETFs or some individual stocks, and they use that $25,000 from there. They transfer it over to self-directed IRA. They invest it, but there's still some left over in that Schwab IRA as kind of a backup. So you do want to kind of look at this a little bit strategically to say, all right, this can go wrong. Here's my plan in case I do need to add more money to the self-directed IRA.
Yeah, that makes perfect sense. And another question that I hear sometimes from investors, looking at self-directed IRAs and using them to buy properties directly, is the difficulty in getting a non-recourse loan. You can't just call up your normal bank and ask for a mortgage for a self-directed IRA necessarily. Can you speak a little bit to some of the challenges that you've seen and how people have gotten around those challenges in getting a non-recourse loan to buy a property under their self-directed IRA?
Yeah, I think the biggest thing you have to look at or analyze is the cash flow of the property, because it's going to be scrutinized by the lender. The lender
use like DSCR.
They're going to look at it, and they have their own set of ratios that they want to see. And they've done many. They're specific to IRAs, so they know what they're looking for in terms of this is an acceptable property that we want to lend on. And whereas it may be easier to get a loan on a property that you're not using your IRA for, based off the financials, they're going to look a lot more stringent. They're going to evaluate it like it's a commercial property. They're going to look at different things like cap rates and, like you said, DSCR, and they're going to want to make sure that this property can support itself, because they know the risks of, like we just talked about, if it does need more funds, how are you getting those funds in there? And because of that, because it's deemed more of a risky property, like I mentioned, the interest rates are usually higher than they normally would be. So what some people do is they kind of give up. They say they'll explore getting a loan and they'll give up. And what they'll look to do is bring a partner in themselves, and they almost create their own little, not syndication, because a lot of times it's maybe a couple of friends or a family member. And technically you can actually even partner with yourself on these investment properties. So you might be able to, let's just use it, say you're buying something that cost $100,000. You may be able to buy $50,000 in your name and $50,000 in your IRA. Or you might add a third person in there who has an IRA or does it individually. So there are different ways to do it. I've seen that approach occur more than people going out and getting loans on their IRA, for their IRA.
Yeah, because everything that I have seen, I have not done this personally. I for reasons that we won't get into here, but everyone that I've ever talked to who has bought properties directly with an it's been a lot of trouble. It's been a lot of work, which is why so many of our members in our investment club prefer just to write a check from their IRA for $5,000 into a syndication deal and call it a day. But let's dive a little bit deeper into one of those challenges, and that's the UBIT. So can you explain to us what that is and why it's an extra wrinkle here if someone were to go out and buy a rental property directly with their IRA and finance it with a mortgage?
Yeah. So UBIT is an acronym for unrelated business income tax. And what that means is, if you, like, going back to the example of someone has a Schwab IRA or a Fidelity IRA and they're investing in funds or stocks, they can't go and get leverage and margin and buy more, use their IRA to buy more stocks or funds. So what the IRS says is, well, since they can't use it on this leverage on this side, we know that real estate, there's a lot of leverage involved in general, and it's going to probably be used. However, there has to be some kind of consequence for allowing that. And what they do is say, if there's leverage used on the property you're buying, there potentially, and most likely, is going to be tax that's owed on the financed or on the portion of that property that there's a loan on. So there's basically a calculation that looks at what percentage of the property is there a loan on. It looks at the net income and then attributes some of that net income to the percentage of the property that has a loan on it. And therefore you may be filling out a tax return for something that you think was like a tax, strictly a tax deferred account. So like you mentioned, it does get complicated with the tax piece of it. And, like, real estate has its own inherent tax benefits in it. So you have to weigh that, things like depreciation, you have to weigh giving up those things to using an IRA. Because if you do use an IRA, you're not able to take advantage of some things like depreciation and some of the other tax benefits involved. So you kind of, like everything, there's pros and cons, and you just have to weigh the pros and cons and make that decision of, is it worth it to use my IRA for this, or is there another way to invest using other funds?
And that is precisely why I don't use the self-directed IRA for real estate investing. Real estate, as you said, has its own tax benefits. So I use a conventional IRA with Schwab for as a Roth IRA that holds some index funds, and to give myself some tax benefits with my stock investments, because I'm going to be investing in stocks in addition to real estate anyway, right? So I might as well get some tax benefits on the stocks and leave my inherent real estate tax benefits in place with my property investments. So anyway, not to get off on a tangent there. So I want to talk for a moment about how investors can use real estate to cover their kids' college education, because that's something that you and I touched on briefly before we hit the record button here. So tell us a little bit about how some of your clients are using real estate investments to cover education costs. Yeah.
So typically when you hear about college education, you think 529s. So there's a tax benefit to using a 529 account. And at a high level, what you're doing is you're putting in after-tax money into this 529. Hopefully, as your child is close to, as young as possible to get those tax benefits. And that account is growing without having to pay tax. And if you use that account for college education, and it could be used for a couple other things as well, you never have to pay tax on it. So you're getting away from having to pay any capital gains, any interest income on that account. And it operates similar to a Roth IRA, and that post-tax money goes in and you get to defer paying tax. And if it's used for education, you don't have to pay tax on it. Now, some people who really are into real estate investing saying, I don't want to do that. Then, they'll talk about, what if my child doesn't go to school, or if it can't be used? And they say, how can I use real estate to pay for college education? And we'll go over a quick high level scenario where this can be done. So let's just say someone purchases, and I'll just use an example, just a simple round number example. When their child is born, they purchased a $100,000 duplex, let's just say, for example, and they put it on a 15-year loan. They get a 15-year loan on it. Obviously, the cash flow has to work, or it has to make sense for this to work. But if it goes on a 15-year loan, they'll have it paid off after 15 years. And by the time their child approaches school or is getting close to college, what they can do is, there's different ways to take out money from that, but they can refinance it, pull out equity, use that equity to pay college tuition. Now what they do is they still have a real estate property. and they were able to pull out money and use to pay for their education. Whereas a 529, it's great, it has its own tax benefit, but it's a depleted asset. So once you use it, it's gone. Where in the real estate, strategy or scenario, they'll at the end of this, they'll still have a real estate property, which hopefully still cash flows positive even after refinancing the funds out of it.
Yeah, I love that. And that's a strategy that we talk about sometimes on this show and on our blog of, instead of selling a property, you just keep it, let your tenants pay down the loan for you. And once they pay it off, you just pull the equity back up by refinancing it. And you can just keep doing that over and over and over again. Again, like you said, as long as it's cash flowing, right? You don't want to borrow so much that you end up with negative cash flow, but then you end up with ongoing income from the cash flow from the property. And, every 15 years or, maybe every 20 or 30 years, you get to refinance it again and keep pulling equity out. You never have capital gains tax, and you can use it for retirement income when that time comes, and then pass it on to your kids in your estate, right? And then no one ever pays any capital gains tax on it. So it's a great strategy to use. Well, Marc, before we wrap up here, I just want to give you a chance to offer any final tips, tricks, hacks that anyone can use to build wealth faster, anything that you see among your clients as a common mistake, or something that you wish more people knew about building wealth?
Yeah, I think one of the things is, and kind of how I got involved in real estate was as a way of diversifying from some of the other types of investments. And I'll see, people will get so emotionally attached to one strategy. And that, when I say strategy, it could mean real estate. I'll see some people that will have their entire investment portfolios in their company stock. Some that will have a particular company that they just, like an Apple, and they'll say, I want to just put everything into Apple or this tech company or that tech company. And there are benefits to diversification. And that's the reason I got involved in it. And, it's a lot of people that are real estate investors, some of them or a lot of them work in the real estate space. So you don't want your job, your investments, everything tied to one industry. Whereas you may know it, and that's great. And it's good that you're comfortable in that space, but you do want to look and just see how can diversification help, over a longer period of time.
Yeah, I love that. And diversification is one of our core values in our investment club, where we try to invest every single month with different syndicators in different geographical markets with different property types, retail, industrial, multifamily, mobile home parks, because I don't know what will happen in any one industry over the next 2, 3, 4, 5 years, but I know that over time, the law of averages will protect me, right? Yeah. Especially if I'm investing every single month, small amounts in different property types, different cities, different sponsors. That law of averages will protect you over time, even through that roller coaster of the real estate market, the stock market, in the market cycles in each property type. So I love that. Marc, how can people connect with you if they're interested in working with you?
Yeah, so we do have a podcast. It's called The Agent of Wealth. You can see it on any of the podcast hosts or agentofwealth.com. And also you can connect with us from our website, which is bautisfinancial.com.
Awesome. Well, Marc, thank you so much for joining us today. This was a great conversation.
Thanks, Brian. Really appreciate it.
Absolutely. And guys, if you enjoyed these conversations that we have, please rate, review the show. It means the world to us. And we will catch you next week. Same place, same time. Bye now.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have averaged returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rentals Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.